this.
All right, good afternoon, everyone. Welcome to the second set of presentations of the spring semester. By that, we mean that every student in the AIM class of 2023, other than Matt, who's doing his first pitch today, will have done at least one pitch. So this is the second round, and we're looking forward to some really strong presentations. We have 5 stocks being presented, 2 of which are in the international fund, and 3 are in the domestic fund. Nice variety of courses, companies that are included here. Looking forward to the presentation. And our MC today is going to be Dr. Wall. Joe?
Welcome again. I look forward to hearing about all these wonderful things. Alex, our first victim, come on up. I mean, volunteer. Yeah, so Alex is here presenting us a 3PE stock in the lumber industry. I look forward to seeing how he's going to tackle it. Alex, if you take us away with the obvious, how you came about this wonderful opportunity for us, as well. If there's one thing out there that you think needs clarification or you want to clean up before we hit Q&A, that'd be wonderful.
Yeah, certainly. Thank you for that wonderful introduction, Dr. Wall. As you mentioned, I'm Alex Mastalish, junior part of the Applied Investment Management Program, covering international materials. Kind of my pitch process and thought process for this go-around was I noticed our holdings in the international materials sector are all metal, or have some sort of metal concentration. So I wanted to diversify that holding and pitch something outside of that micro industry or sector inside of the sector. I originally did a lot of research and analysis on a uranium company that did not have enough upside or, in my viewpoint, enough merit to pitch at this time, just given some of the constraints of that industry and that material. I then kind of went back through my screening process, selected West Fraser Timber, just given what I had read about it and some of the research, undervalued, strong balance sheet company, well run, and that was something that I valued. One thing that kind of came up in D2L is kind of that front box of revenue assumptions and margin and earnings per share. As you will notice, from 2022 to 2024, they are decreasing. This was done out of a couple of factors that I will talk about here in length, but to sum it up shortly, lumber is at a very high trading price at the moment, and so with lumber prices falling, they're not going to have the opportunity to not only gain the revenue that they were getting at that high level to that extent, nor will they be able to earn as much as that. That does not diminish its value or the fact that it is currently undervalued due to recent developments in the macroeconomic world.
All right, Dr. Cross, lead us away.
All right, so I appreciate what you just said there about your revenue numbers. This is a price times quantity equal revenue sort of model.
Yeah, absolutely.
And so I see that you have total revenues declining.
Yeah.
But is unit volume declining in the future? And if not, what is your estimated organic growth rate for revenue?
Yeah, so I have revenue or unit sales increasing. And that's something that they've historically done, given, so when the pricing of lumber falls, they're going to want to produce more lumber. They're going to want to sell more lumber to make up for that loss of where it was from prior pricing. And so I do have that forecasted out as unit sales increasing, obviously to a certain extent.
How much?
I believe I had just a little bit of a 5% kick each year, just given their where I think the market's going to go. Obviously, there is a cap on that in each segment, just given that demand ultimately you can't produce more than you, or you can produce more, but you're finding that balance between supply and demand.
Okay.
Who's next?
Questions? Those ROA numbers, and hence the ROIC and ROE are really large. And that's, we like that, right? We like very profitable performing companies. What is their typical average ROA or ROIC over a period excluding the pandemic period?
Yeah, that's a very fantastic question. I can get back to everyone on specific numbers, but if I remember correctly, it was around the 20 to 24% range.
Everyone over here?
I can hear. Alex, nice job. I have a question about your first driver, the acquisitions, especially WFG. It was announced in December 2021. Do you think that because of this announcement already occurring, that it's already priced into the share price this acquisition is occurring and the advantages it would bring, or is it still waiting to be priced in?
Yeah, certainly. Great question. So Andrew kind of asked about if the acquisitions in December have already been priced into the share, or if the benefits are going to be taking place after. It's in my opinion that a lot of that benefit that's coming from that is going to take place in the future, just given that some of the acquisitions in particular dealing with the mills will not start up to capacity until 2022 into 2023. So that benefit that they can gain is not an immediate start and stop. It's more of a gradual working in process, even though one of the mills is technically a turnkey, which means it's ready to go. It has been operating, but they're going to, obviously through the transition, kind of not operate it and then move it up to capacity.
Rishi.
Yeah, so as far as with Andrew's question, what are they going to pay for those acquisitions? What kind of multiples is that for?
Yeah.
Maybe looking at stock price, why is the stock price ripped up lately?
Yeah, certainly. So two-part question there. He's asking about the multiple that they paid on that, and then also just kind of how they used to fund that acquisition. Both were used with cash and short-term investments for both acquisitions. The first one was $300 million. Second one was $280 million. As for the multiple, I would have to get back to you on that with a specific number on the multiple that they paid for it. And then, stock price. Good question. So it's actually, in my opinion, that it's getting hit a little bit more than what it should be, just given that there is still a decent amount of, so 90% 95% of the revenue is correlated to lumber pricing. And so right now where future lumber prices are traded and where lumber is currently trading, I think the street is hitting it a little bit harder given where when they announce quarterly earnings in Q1 and in Q2, I think they're going to outperform kind of where the street has it at.
So we've gotten online, but I'm going to jump in ahead of it for a second. My question to you is, one I'm just thinking about is, does this company hedge pricing?
Hedge pricing?
Yeah, right. If you're telling us that this company basically can make an awful lot of money if prices stay where they are right now, why in the world, or maybe they do, wouldn't they go ahead and forward sell their future production so that they can keep these spreads, and then you don't have to be up here telling us how everything's going to go down, down, down?
Yeah.
But have we had any discussion about it?
It's my understanding of the industry that that's not the typical norm to kind of price in a forward contract, given how volatile the industry is, right? So currently, if you go out to CME Group, lumber futures don't trade past 1 year.
There's your answer. Thank you.
So
they can't hedge.
essentially, they can't hedge even if they want to, and there's some things that they can do to price manipulate, but it's not substantial.
Yeah, endorse price manipulation.
It's not, and to say, I don't think they can, but there are things that they can do, obviously, the supply and demand too.
All right, we've got an online question from Joe. It looks like, what are the acquisitions adding to revenues per share?
Yeah, certainly. Great question from Joe. It's my understanding that the acquisitions of the Northward acquisition added 2/3 EBITDA for 2021. So that was the one that they made in early 2021. As for future looking, I don't have an exact number on that. I would have to get back to Joe on that.
So basically what you're telling us there is your acquisitions are bringing 2/3 of your operating income.
In 2021 for Northward, which was a European acquirer plus some in North America. I think
What
Joe's
percentage did Norwood represent of their revenues?
their revenue.
Yeah,
I believe it was roughly about 13%.
Yeah, so 2/3 of 13%.
So about 5% of the
Yeah.
that helps.
On that.
Question. Could you talk about, so they're increasing their dividend, they're making all these cash acquisitions, and you mentioned investment in your second driver. Could you shed some light on cash flows, what their cash position is like, and if any debt is coming to play on that?
Yeah, can you repeat that last part of that question?
Shed some light on cash flows.
Okay,
I'm sorry, I didn't know your cash flows, their cash position, what you expect going forward.
Okay. The reason I asked you to repeat it is kind of sped up at the end there. But to shed some light on cash flow, it is decreasing given where they have to pay out with dividends and capital expenditures. Management, though, is pretty confident on their current cash totals and short-term investments, and going forward, I'm pretty confident on that. As for debt, they're pretty low levered, and I don't really foresee them having the need to take out substantial amounts of debt.
Do you have any numbers associated with free cash flow?
Yeah, I do have numbers associated with free cash flow.
Trends in the past couple of years, anything like that?
Yeah, I mean, cash flow's increased in the past couple of years, given in 2020 and 2021. As for numbers going forward, I would have to get back to you on the exact number on percentage-wise, but it is slowly decreasing for free cash flow, given where revenue is.
Have you factored in the risks of like forest fires and stuff like that on the West Coast?
Yeah, great question. I did factor in a little bit of that into my transportation costs going forward, and kind of expenses. In particular, they were hit pretty hard in 2021 with forest fires and flooding in British Columbia. So I made sure to increase my transportation costs by about 1% each year, just given where I think the direction, A, of supply chain shortages, but also the fact that these forest fires and flooding, they do tend to occur. So just kind of factoring that in as a possibility.
Awesome, thank you. Yeah, Alex, good job. Could you just talk about how you chose the weighting for your peers?
because it looks like Louisiana Pacific and UFP are kind of the, I guess, have higher multiples than what West Fraser has.
Yeah, absolutely. So the main reason I chose those two peers to be weighted higher was I feel like they incorporate and encompass kind of the business models. They're very similar between both of them, as well as the fact that they're larger in scale, right? So Mercer and Boise Cascade are a little bit smaller scale companies. And so I don't feel like while they're valid to be included in the peer group, I just don't think they need it as high of a weighting as Louisiana Pacific or UFP. But I can also play around with the weightings wherever you would like them to be.
Thanks a lot. Appreciate you. Next up, August, come on up and tell us about this exciting insurance opportunity. Same thing, how you stumbled on it, and then you got a lingering question out there, or any commentary you want to have before we begin.
All right. Yeah, I'm August Peterson, if I haven't met you before. And I'm just going to get right into what I want to address because I've got a little bit of explaining to do with my very controversial peer group. I want to address the peer group 1, and then 2 is the insider selling. So as far as the peer group, I've replaced the PE ratio with the PEG ratio. And if I just do that, I get an intrinsic value of $121.20. If I take out GoHealth, I get $117. If I take out Chegg, I get $120. And if I take out both, I get $117. I didn't run an analysis taking out Planet Fitness, and I know that's kind of, I don't know, a little bit striking because like they're not in the same industry. But when you think about it, Goosehead, most of their premiums are coming from the franchise channel. So if you think about it that way, their franchise channel is more valuable than their corporate channel. So if you're comparing franchise businesses, Planet Fitness has a very similar beta, long-term expected growth rate. They've been on the market for the same amount of time, similar market cap, net margins. Both are competing in a pretty highly saturated industry with about the same market share. So that's kind of why I incorporate that. As far as insider selling, so just a little bit of backstory. I'm trying not to take up a ton of time, but so in 2018, Goosehead went public as a holding company of the operating entity Goosehead LLC. And in that structure, they took 35% of the company public, and the other 65% was still held by two groups, Mark and Robin founders, and then the Colby brothers, which I mentioned in my management section. But since then, since 2018, that non-controlling interest has gone from 65% down to like 47%. So like throughout that time, a lot of insiders have been converting their Class B to A and then selling that off into the market. But when I dig a little bit deeper, I noticed that there are two family trusts that the Class B shares are issued to. So there's a Mark and Robin family trust where 98% of their Class B shares are given to them. And then the Colby family has a similar structure. So when you see in the news like Michael Colby sold $2.5 million worth of stock, yeah, that's true. But that's being indirectly sold through his family trust, and the selling has been consistent since they went public in 2018. So independent of the stock price, independent of what the company's operations are doing, they're going to continue to sell. And I can only speculate as to why they're doing that, but I do know that Mark and Robin have since become like one of the top 5 largest landowners in the state of Montana. So it looks like it's a diversification play. But yeah, with that, I'll go into Q&A.
All right. So my opening question commentary, August, is twofold. One, do you have any sense of what the PE looks like from your model in, say, 2025? Yeah-ish, ballpark. Because I worry a little bit. I get the idea we're disrupting things. I just want to make sure we're not still at 86 by the time we get there.
Yes. Actually, I don't, but in 2023, I can give you that.
It's fine. It's probably too close to bring it down a lot, but maybe I'm wrong.
Yeah, I mean, it's 66 times.
Yeah. Okay. So one thing, August asked a good question this morning. I wish we had a chance to talk a bit earlier about together. Is, gosh, Dr. Rowe, I found it disruptive industry. I don't feel like there are any peers, and so this whole comparable valuation thing I don't think matters. And I said, well, my commentary back to the crowd is, it's, we can strip out all these and do what we want, but I would encourage you to look at alternative means if you don't think this comp structure is a fair representation, even if we reconfigure it and call it pegs and things. consider the fact that there are other businesses that are similar levels of startup, and you can actually go out throughout points in history. Now, it's hard to compare a Russian war time to something else, but you do have methods available to you that are very out there. We haven't done one in AIM yet that I know of, but I would have gladly worked with you to make one that's based on historical stages of growth for comparable type of structures, and then we could construct your own comp that would hopefully make logical sense to you, as opposed to saying, I don't know if I buy any of this. Fair enough? Yeah. So in the future, if you run into this, that's what Dr. Krause, Professor Walker, and myself are here for. Please, we'll help you come up with some crazy thought, and we'll do our best to capture it in a way that hopefully makes sense to you. Fair enough? Yeah. But I appreciate the DCF. I appreciate the color in the 2023. Questions?
Here, quick one.
Yeah.
Not to be argumentative, because I'm not taking the side of the insurtechs or whatever, but that purely is the competition for that. This is not an underwriting insurance company. They are distributing. And I know you believe in their ability to meet customer satisfaction and bring on carriers. Convince us that they're not going to be replaced by insurtech on our smartphones.
Yeah. Yeah, that's a great question. And, kind of one of my first drivers talks about how the industry doesn't really actually prefer to buy insurance through a smartphone. Like this year, I think 80% of premiums were sold by an agent, and 5 years ago it was the same number. So there's really no change. And that just tells me that 8 out of 10, clients still prefer to buy from an agent. And I did a little bit of research on my own, like looking at rates in my own home. And I went through a peer like Lemonade, who's like another popular personal lines insurance. And they offer their whole thing is in 90 seconds we can give you a claim, whatever. And it was super quick and easy. But when you look at the details, Lemonade's personal liability was only $100,000 coverage. And I think the industry average should be $500,000. And then they don't even offer water flood damage, which is the #1 filed claim for homeowners insurance. So it looks like a good idea, I guess, on paper, but it's I would almost use the word cunning. They just kind of give you the least amount of coverage for what they can offer. And even on top of that, Goosehead has better prices. If you're trying to compete with an insurance company that sells their own product, their own insurance product, their own carrier, they can only sell their own insurance.
So comps matter to you?
Yeah.
Just kidding. Totally kidding. All right, what else we got out there? If I will do that, that's fair. Yes, sir. Sure. We got back to that. Go ahead.
I was just curious on if you have any data on how pricing impacts the consumer, because it looks like in the insurance space there's a lot of direct sales. So how some buying insurance through an agent differs from buying insurance through direct sales, and if there are any cost savings from direct sales, and if that might be a risk for your company.
Yeah, I sort of understand that question. Are you saying what are the benefits of going through a captive agent rather than
right,
independent agent?
Right, there's a lot of direct sales in insurance. You can buy insurance straight from without an agent in the middle. So that might offer some cost savings perhaps to consumers.
Yeah, kind of like I said before, 8 out of 10 still prefer to buy from an agent. But I guess there are some benefits if you go through directly Geico or something. And if you've been a customer for 10 years, you can get some bundle discounts and things like that. But I don't think it's really anything that much more than what Goosehead can offer. They still have 140 carrier relationships, so they offer pretty competitive prices, but I really don't see a whole lot of advantage going to another agent.
And it's just for clarification, I guess, Goosehead can sell, Goosehead agents can sell you insurance from 100 different insurance companies. Yeah. So they'd be competing with I guess for State Farm, could they be competing with one of their own agents and selling the same insurance as them?
Yeah, exactly. They're just a company that sells the insurance for the carrier. That's all. Yeah.
Sorry.
All right, so I just one blocking and tackling question, one question I want some insight on. Blocking and tackling, I see it's a Class A share. Is there a Class B, and what kind of restrictions on this?
On Goosehead?
Yeah. Are there other classes of shares out there?
Yeah, there's a Class B. That's the insider holdings that's not offered to retail investors.
Voting differences, stakeholder differences.
I don't know that specifically, but
That's fine. And then I just want some clarification. So they know 1.1 stop charge justifies that. But I guess my question is, if it's tracking almost 1-to-1 with the Russell 2000, we're taking some more risk on by adding this, as well as adding risk in from insider holdings and short interest and a negative ROE. Could you kind of sell me on your company and why we shouldn't just take this money and go with a passive investment?
Yeah, I really don't see a whole lot of risk, especially with insider holdings. I kind of touched on it before. Like, it doesn't matter what the stock does or how they operate. It doesn't really affect our ability to generate free cash flow. So I did include like a 25 bip increase on my WACC, just in case they sell like abnormally or something like that. Other risk, I don't know. Could you kind of like rephrase the way you said that, I guess? Because I just,
Yeah, I guess pitch to me your belief in the business model and investors' belief behind this business model. And why we should pick this over the rest of 2000.
Yeah, that makes sense. So Goosehead is pretty predictable recurring revenue. When you think about like how every dollar is made, you basically have the corporate channel and the franchise channel. With the franchise channel, Goosehead makes 20% of every initial fee that franchisee sells. So they'll get $20 on a $100 claim, and then the next year they'll make 50%. That's the policy. So they go from 20% to $20 to $50 in the next year off of no increase in sales. So and if you adjust for like retention rates, it's maybe like $45. But if you like continue this trend, revenue grows, almost, it looks exponentially. Obviously, it doesn't have that relationship, but off of no sale growth, revenue continues to grow. So I think it's, I don't know, high recurring revenue. It's very predictable. I really don't see a ton of risk in it. But I will say, when I increase my beta 0.1, my intrinsic value does drop $5, if that kind of gauges your risk.
Hey, August, nice job. So, looking at your revenue assumptions, you got like 30% in your revenue growth rate. It's pretty aggressive. So, I kind of have two questions here. So, one, how is that relative to how it's grew the past 4 years? And I also kind of want to understand, what influenced your assumptions? You built your 10-year DCF, and from what I'm looking at, you go from about $150 million in revenue in 2021 to about, I believe it's $1.5 billion come 2031. So, that's a 10x increase.
Yeah.
So, did you do any sort of sensitivity on that, or can you give me some color there?
Yeah, so the last 4 year CAGR revenue growth has been 36%. So if you look at my X5, it doesn't look as aggressive as that was. But so that was the growth. The reason I did a 10-year, just sort of capture that margin expansion a little bit more. I didn't do any sensitivity analysis on the revenue change, but when you really break down how I forecasted revenue, I personally don't think it's all that aggressive. I think my most aggressive number is probably initial corporate sale fees, and I forecast that at half the rate that it's been growing at in the last 4 years. So when you understand like how renewal revenue is generated off of the first dollar, like the revenue makes sense. And I don't think that my assumptions are all that aggressive. I know I'm not explaining that super well, but without a model, it's hard to really see what I'm saying. But yeah.
Go with that.
Yeah, we're good.
Yeah, August, good job. So I asked this question on D2L, and it's about your second risk. And it kind of had me, when I was reading through it, kind of caught my eye. I think it's important if other people kind of saw it. But could you just talk about that second risk? Because I personally think it's a really good company, but just explain that second risk for me, seeing your response was.
Yeah. So my second risk is basically in the event that consumers do want to go through not an agent anymore. Like, what are the implications on Goosehead for that? And that, I mean, when you think about like the personal lines insurance space, customer acquisition cost is like $1,000 per customer. Like Geico spent like $2 billion. Progressive spent around there. Berkshire Hathaway a little bit above that. So it's obviously a really competitive marketing space. And Goosehead's referral structure has, given it an advantage where they've been able to grow at 45% premiums without any advertising spend. So basically, this second risk says what happens if they do have to start engaging in the marketing area. And they did release last year a digital agent, like a technology that they have where they can essentially connect you with an agent right away and quote you a claim in like 2 minutes or less. So it kind of parallels that of like other insurtechs. They're obviously not like branding that super aggressively because that's not the space they're in, but If need be, I can see that kind of taking off, but yeah, that's all I can say.
Last question.
So they have negative stockholder equity, and their net debt is about 5 times free cash flow. If capital markets dry up, is there a risk that they won't be able to fund their business, or any of these notes coming due?
Yeah, that's a good question. I don't think so. They've been profitable anyway. I think looking at like a negative ROE, it's easy to say like, oh, this could be a danger, but it is, the negative stockholders equity. It is profitable at the end of the day.
What are the notes too? The big chunk? The notes, the debt structure, when's the biggest note due?
The biggest note, it doesn't divide like that, but I know like 5 years out, it's 60 million of the 110 million right now.
Okay.
Yeah.
Cool.
So.
Thank you. Thanks.
Thank you,
All right, next up, we've got a hedge against our massive Russian oil holdings. That's right.
We don't have it.
Yeah, I know. That joke on multiple levels. Well, Margaret, talk us through, always fun to hear about renewable energy. Can you talk us through how you found this one? And then it's the same thing, if there's any question, we'll go from there.
Absolutely. So I was looking for a stock to pitch for this pitch. I was looking for, and covering the energy sector. As we all know, the fund discourages investing in oil and gas. So I was looking for a renewable company, and with the tumultuous environment in the market right now, I was kind of looking at utility companies. And so I found Iberdrola. This company is a utility company, but it has an exciting segment of renewables that has potential for a lot of growth in the future. So they have a strong financial background, and their balance sheet is impressive. And I thought that with their strong historical performance and also the exciting opportunities in the future in green hydrogen and in the renewable space, I thought it would be a good addition to the international fund. And I don't think there was any specific question that kept on coming up in D2L. So with that, I'll open up to questions.
Yeah, I'm going to ask you about regulation. Okay, this is a utility,
Yes.
and really that should be some of the first things we think about. Are they regulated by the country of Spain and the other countries they operate? And is the regulation limiting their ability to earn a certain return on equity?
Absolutely. So with Iberdrola, they have their main operating segments are in Spain, the UK, the US, Brazil, and Mexico. And with each geographical revenue segment, there are different regulations at play. With their network segment, it's definitely more regulated, and with my assumptions, I kind of kept it with historicals, and I didn't go too crazy. But with the renewable regulations, they are very favorable towards the company, and I'm more willing to go into more specifics there. But
Did you actually happen to see that is ROE capped at a certain level?
it is kept for the network segment, and I did factor that into my model.
Okay, thank you.
But that's just one of their segments, right?
Yes.
Yeah. Interesting. All right, can you walk me through Ørsted as a comp? I don't know anything about it, I'll be frank, but I see that it's adding a bit of upside. It's got upside on its own, but especially if I were looking at metrics you didn't use, it's got a ton. So I just want to make sure that's a good comp. Can you help me understand that one a little bit?
Oh, definitely. So my idea behind my peers was I picked 3 typical utilities. That was the Exxon, that Energy, and First Energy. And Ørsted is a pure renewable company. So I thought that kind of had a good evening out in that sense.
Next up. I'm going to give her a pass.
Yeah, I guess I've never seen someone use a 7-year DCF. I don't want to hear your clarification on why.
Absolutely. So I, with it being a utility company, I thought I was going to use 5, and then with this large renewable segment, I thought 7 was in between 10 and hydro.
And I assume some of that's coming from hydro. I'm going to ask you a wild card question. Do you happen to have any idea what tech they're using in the hydrogen space? Or they?
With hydrogen?
Yeah.
Hydrogen? Yeah, they,
So I know there's at least 2 competing.
yeah, there's an alkaline. We use both. There's the alkaline and the, I can't think of it off the top of my head, E. But, yeah, we use
Okay, thanks. Dr. Cross?
Yeah, again, back to the regulation here. They're not just in Spain, they're in other countries as well.
Yes.
And even though their return on equity could be capped, they still have to get permission before they expend money on plants and capital. You say the regulatory environment in Spain has been favorable towards this. How is it in other countries?
Favorable as well. I can go into specifics.
Yeah, tell me how you did the research, where you found that.
Yeah, so what I found really interesting about this company too is that they were named the most transparent company on the IBEX 35 in Spain. So they actually have a ton of information of the fact book on all the regulations in each geographical segment. And so with that, I was able to model out with the increase in capacity going forward, it's supposed to multiply by 2.5% going forward, and those are all mostly approved projects around the globe. So.
And the reason I keep hammering on this, you got a 50% upside.
Yeah.
Okay? And generally, utilities aren't allowed to earn large amounts of money because that means it's coming from the ratepayers, et cetera. So I just wanted to make certain that there's not a point of their ability to generate profits that gets capped out. You still feel good about that 50% upside?
I do. I was able to take, so the way I modeled out the renewable segment is that I was able to take a capacity factor times the price that they have going forward for each kilowatt hour of energy, and I was able to take that times the capacity, I think it was the capacity factor and something else not in front of me, but I feel confident in it.
Okay, good, thank you.
Yeah, can you tell me the green hydrogen a little bit? What does an R&D spend look like for that segment?
Yes, so they're one of the bigger spenders in the play. I think it's around like $70 billion going forward. And their mission is to become the biggest player in that space. So going forward, in the next 10 years, their prices are supposed to be competitive with gray and blue hydrogen, and I think they're in a really good position to be competitive in that.
Margaret, in your write-up, you talk about how the company is in a prime position to profit from the different geographical operating segments. Could you talk a little bit about how you factored in each country's GDP and how do you?
Definitely. So I found some sources that where I projected out each country's GDP for the next 2 years, and I did a weighted average based on the revenue segments, and that's how I kind of came to my terminal growth rate. So I feel confident in each segment in the growth rate.
Awesome, thank you.
Thanks, Wayne.
Yeah, my question's gone.
Okay.
Mr. Walker, can you educate me on how, so we have this big installed base of maybe coal or big plants, dirty plants, now we're moving to renewables. Those are, billions of dollars of costs. Wind farms and solars can't be a fraction of that investment. So how do you write off these and invest in solar fields, which are less capital intensive?
Yeah.
And not screw the balance sheet. I don't get how you can get rid of all that, the old stuff, and move into the solar stuff at rates much lower than the coal stuff. I don't understand the transition.
Absolutely. So the liberalized segment is a segment that encompasses a ton of different technologies. It's not just coal. It's there's retail, so they do a bunch of different wholesale energy, selling of energy. So they're shutting down their plants at a rate, although fossil fuel plants at the same time they're opening the other ones.
But if you're paid on investment, the dollars got to be less on solar than there are on coal, because you have such a big installed base versus a much smaller dollar installed base here. That's what I'm trying to get at. How does this transition work?
Right. I think that's going to get super help in the space. And I can say, but with yeah, I can go back to that. Sorry.
Good try.
That's a question. Just diving deeper into renewables. Also, good job, Margaret. Could you just share how the percent of revenues has trended over the last couple of years, since it's 15 now? What has it done the past couple of years? What do you expect it to be with green hydrogen? And then, yeah, you can answer that question.
Yeah, absolutely. So I expect it to be by the end of the, I have it modeled out, end of the 7 years, it's supposed to be about 25% of the company. And in the past, that's historically how it's trended. So it's been going, so I can get back to the exact numbers.
Well, and then, do you have any numbers on market share? You talk about them being the largest in Spain, in parts of the US, but like Brazil, Mexico, do you have any numbers on their market share, or what you expect it to be after the green hydrogen launch?
I don't have specific numbers, but I do know that they're one of the 3 top players in each. Thank you.
All right, thanks. Appreciate it. All right, Matt, come on up. Hop on up, I should say. I was doing that in December. Sorry to see that. Same thing, Matt. You got bank. Talk us through why you think this is our best choice for a bank. And if you have any lingering question that you want to address before we get rolling, do so, please. Thank you.
My name is Matthew O'Brien. I'm a junior here in the Applied Investment Management Program. Part of my screening process for Nicolette, I was primarily looking for strong fundamental growth between revenue, net income, loans, deposits, and assets. They've grown at a strong CAGR the past 5 years. I was also looking for an active player seeking to gain share in the fintech space and someone that was actively seeking to gain better income. One question that I received a lot of was why my net income jumped from 0.3% to a 25% gain between 21 and 22. The box was mistaken, actually. It's between 21 and 22 that the net income grew 25%. And the reasoning behind this was because in 2021, Nicolette had 2 mergers, which impacted their net income. So there were $14 million of day-2 seasonal credit provisions, $6 million in integration and merger expenses, and $1 million to branch optimization. So the non-GAAP net income was found to be about $73 million for 2021. And with that, I'll open up for questions.
Mine's going to be price to book. Help me understand a few things here. You got price to book in your write-up at 117 for your industry. You got 113 in the table. Can you guide me to which one's right? 117 here, 113 here.
No, so this is the pure average.
Okay, so 113?
113 is the pure average.
Yeah, and you got 117 in your write-up. Which one do you want me to look at?
Use the one.
Okay, and so if I'm using 117, and mine is 149, assuming that's right?
Yeah.
When I do the math of 117 divided by 149, I don't get anywhere near $97, which is what you're telling us it's worth. I get something that's about 2/3 of that price. So can you justify this 97.36, which to me reads suspiciously similar to their share price, when using that method should be producing $66, just doing some quick math in my head.
I would have to look at it.
Please get back to the whole group on that, because I worry that actually tips this to a downside situation, believe it or not. So I want to make sure I understand the PV method. Thank you. I don't have this first edit, but yeah, if you can get to us, that'd be great. Thanks.
Yeah, great work, Brad. Saw twice mention Kelly Fisher. I just wondering if you could express some background into her background or add some color into who Kelly Fisher is and what is she going to provide to the company. So Kelly Fisher was a operating officer for a competitor, First Bank. The new position that she was hired for, she's specifically tasked to oversee innovation and fintech investments. So they're actively pursuing ways where they could create an easier experience for customer usage. And Kelly Fisher is sort of leading that
information for Nicolette.
Thank you, Dr. Krause. Hey, Matt, this is a regional bank. We haven't pitched a regional bank in quite a while. Regional banks are strongly dependent on the local economies. And this is central northern Wisconsin and the UP. Okay? So what's going on up there? From what I know, I know Green Bay and the Fox River Valley is fairly prosperous, but from what I know about northern Wisconsin and the UP, it's slow. And is there enough economic growth for you to feel comfortable with this major player in that region?
So I wasn't able to find specifics on economic growth, but I rather looked at the population increases and how many people are coming into Wisconsin. That is slightly lower than the east and southern states. However, the asset valuations for property in Wisconsin is a lot more reasonable than banks on the East Coast or asset valuations on the East Coast and southern states that people are flocking to.
Well, I'll stay with that. Just one more follow-up. They do commercial lending, right? And they do their share of mortgages for residential. What industries are they serving that you know of in their service area?
So they are serving residential mortgage lending and commercial mortgage lending. Besides the two mortgage lending that they're doing, they do consumer loans.
Do you want to go through how you calculated your beta as well as cost of equity? It seems a little on the lower side for both of them.
So for my beta, I compared the return of Nicolette to the Russell 2000 index. I got a weighted beta of 0.51, averaging the 5-year, 3-year, and 1 year. The cost of equity was low, primarily due to that beta, only at 0.51 with an equity risk premium of 6.5%.
Sorry, thank you.
Hi, I was just wondering, so like how much of the recent acquisitions make up operating income? And then like is the main business model to just keep like buying banks, or what will they do when they're not acquiring more companies?
So recently, most of their value has come from acquisitions. Their assets increased about 66%, and their loans increased about 66% between 2020 and 2021. So management says that they're actively seeking ways to gain value through acquisitions, so they are seeking acquisitions. However, now that they've gained enough share in the market, they're sort of shifting focus a little bit to investments in the financial technology space.
Mr. Walker, just a comment on, I know we looked at the fundamentals of the return on equity for the last 5 years has been up to 11 to 12% over time, but it's dropped to a recent low to I think 6%. It's dropped because of the acquisitions they made just recently. But the observation I'm going to make is that if you looked at kind of normalization of earnings using return on equity over a period of time, you're going to put a double-digit return on equity on book value to kind of get a normalized earnings per share, which would give you a much lower valuation than you can see here. So it's just an observation that this company did so many specific acquisitions in this period of time, in the last 18 months or so, that they're big ones, that they actually diluted their return on equity quite a bit.
Yeah.
But mostly, the net interest rate is the highest in their group, or nearly the highest. So it has the power and higher return on equity. And it does show it. So a normalization of return on equity would have been a good model to use to do an EPS for normalization.
Yeah.
Yeah, two questions. What are the implications of a flattened yield curve on free cash flow? And also, if there's any risk there, how would they weather that by like changing their deposit composition?
So how it would impact free cash flow, I'm not exactly sure about that. However, if the yield curve were to flatten, I think the fact that people need mortgage loans will sort of prevent them from having too big of a decrease in revenue or impact operations too much.
Your second point was
Deposit composition. How it's changed.
so how they would change mortgage or their composition. I'm not really sure. A majority of their portfolio is mortgage lending, so they would most likely have to stick with mortgage loans, and they would have to lower their the amount of consumer loans that they're giving out.
Last question.
Can you kind of touch on your third driver? Because I know I've been to the UP and everyone's so spread out, so definitely digital demand is a huge thing because most people don't have banks and cities right next to them. So can you kind of touch about how developed they are and kind of like the future for that?
So Nikola recently went into the Upper Peninsula in northern Michigan with their recent acquisitions. Right now they have mobile banking, your basic check deposits, transfers, and automated bill payments. They're really just looking for ways to catch up with big competitors on how they can provide value as a community bank that national banks could provide. And they're looking to gain share in UP and Michigan, and by going digital, they can really expand forever.
All right. Thanks. Last but not least, we always have the ever-present Seeds Biotech Center. Kendra is going to pitch us an interesting, difficult to model situation that I thought she did a pretty good job of handling. So Kendra, take us away, tell us how you found this, anything you want us to know, and then we'll get Q&A.
Yeah, absolutely. Like Dr. Wall said, my name is Kendra. I'm a junior. And then I am pitching IBDRY Biotech. And some things I just want to get out of the way when addressing it is the way I screened for it is I kind of did a reverse engineering approach of looking at an ETF and just kind of looking at companies and seeing what they were doing and trying to find, my biggest issue was trying to find a small cap firm that actually was public. A lot of them that I looked up were all private, and I think that's just the nature of the industry. And I kind of stumbled upon IBDRY, and some then metrics beyond that I was looking for were relatively good PE, good EV to EBITDA, and honestly just a positive net income for the fiscal year 21. They are an earlier or younger firm. They were created in 2016. They IPO'd in October of 2019. And then some things that I just want to address from the D2L board is, yes, they do only currently have one product out, which is the Strovimab intravenous solutions, which is used as a treatment, not necessarily like a vaccine for COVID. And if COVID was to go away immediately tomorrow, that would be very, very bad for the company. However, there are very promising prospects for their next solutions, one of which is an intramuscular solution for COVID, which would be more like a vaccine. Another one is a pill for COVID. And then beyond that, they also have scopes looking into like HPV solutions, HIV solutions, and influenza.
Okay, questions? Dr. Krause.
Yeah, this, my hats off to you. Biotech is not an easy industry to analyze, and this certainly is a challenging company. I'm very impressed with the low multiples that this company has. Usually the biotechs that we've looked at in the last couple of years have been really high. This is really quite affordable. I think you got to talk to us about the risk, though. There's a lot of clinical trial risk to this company. And it seems like there's even more risk than you would typically find in a biotech. Can you comment on that?
Yeah, absolutely. So Dr. Krause is just asking about the risks section. So I had 3 risks that I kind of wanted to highlight, and one of them being that there was expedited resistance, which was, kind of a situation that was expected of COVID solutions and treatments and vaccines. It's just that they seem to expedite the process a little bit. But that was also seen with one of Eli Lilly's antiviral solutions back in around January. So IBDRY was kind of expecting something like this to happen because they have a similar technology. And beyond that, there's 2 other solutions that are antiviral. And one of them I don't believe has had any issues so far. So that is just something that
is part of the market that they have expected, and they're also keeping an eye on people that have the mutations that arise. Additionally, the clinical trial failures. Yes, there are high failure rates. However, like with the HPV solutions in particular to talk about, like it's called BI2218, which had some results released in the second half of 2021, and they showed that they had significant reductions in the HBsAg protein, which is one that's linked to HPV, to impressive matters beyond what they were expecting, which is extremely promising. And then they also have more results from the clinical trial coming out in the second half of 2022.
Okay, and here's a real quick follow-up. Did you change any of your assumptions based upon probabilities of some of these being approved versus not approved? In other words, we do sensitivity analysis a lot of times on growth rates. Did you try any kind of sensitivity here on successful FDA trial applications?
So what you're asking is if I did account for necessarily any of these in the sensitivity analysis of the pricing. Because I used a 5-year DCF, I did not include that because at the longest stage, so the stage 2 takes about, I believe it's 2 years for approval, and then stage 3 takes about 1 to 4, and so I was assuming for conservative measures that they wouldn't get approved for out until at least 2027. So I stayed conservative and didn't want to like jump the gun and add it in.
So to clarify his question, because I know your work, basically if any of those drugs get approved, they're going to add upside. Is that correct?
Absolutely.
The only two things you modeled were which?
Strobinet, and then I also.
So all of those future pipelines would only have upside to their DCF. They aren't even built in as factors in the model.
Okay.
Go ahead.
Yeah, I want to understand the business model a little bit of this company. So it has all of this research and development for infectious diseases, and works with major partners like GSK, Melinda Gates, which are major players in the space. Why don't they produce these drugs themselves instead of selling them to third parties? Do they not have the capacity and resources to?
Absolutely, that's a great question. So you're just wondering why they don't necessarily go in as a solo player for this industry? All right, so something that they found is the creator of the company actually previously worked for the Bill and Melinda Gates Foundation, kind of branched off but is still using them as a partner. And then something he found is that there's actually more potential for building up his company if he keeps these partnerships, because then he has more access to a wider net of technologies as well as more patents that he's able to integrate into his own solutions. So like some parts of the antibody platform, like the T-cell platform, or the innate immunity platform, and the siRNA, which are the 4 main platforms I use, some of the technologies and patents do come through the partnerships, which they are just using to further develop their R&D.
So I guess a follow-up, how did you value these patents then, and how would that valuation change if they broke off from the Bill and Melinda Gates Foundation? Basically, how much upside is being driven by this relationship?
So you're asking how much the intangible patents that are being derived from other companies are affecting
The revenue streams from those patents.
So I had a hard time trying to find that just because there are over 100 patent families that amongst themselves, and through an acquisition of a company called Cumulus back in 2016, as well as through the partnerships that they derive all of these from, and they had a hard time breaking up all these patents and specifically addressing them. So there was a lot of research that I wasn't necessarily able to find to fully quantify those numbers.
I guess then third follow-up, what percentage of their pipeline do they have control over versus the patents have control over if they were split? Because I'm worried about right now, you're telling me that this relationship is symbiotic. What if that relationship breaks and BIR decides to spin off? Are they going to have to start from ground zero now?
So let's reframe that so we can stay focused on what she actually modeled, which is just 2 of the 100 drugs. So in those 2 particular drugs, do you have any idea what percentage of the revenues or operations are derived from the relationship with the Bill and Melinda Gates Foundation?
So
Is that okay? Yeah. That's all she modeled. But everything else is pure upside.
as of right now, the current solution or product that's out is Sotrovimab, which is actually partnered with GSK, and they get 72.5% of the revenue from all sales of that product.
that work?
Yes, good.
Oh, sorry. So your third driver, you talk about like the promising pipeline, and you talk about like how the different products are in clinical trials and probably these sold. How did you include that in your model, since it does say like 1 to 4 years?
Absolutely. So you're asking, like, for the ones that are in clinical trials, how might that integrate into the model?
Yes, exactly.
Yeah, so as of right now, they have, I believe they have 5 solutions for HPV in the middle of phase 2 trials, and then 1 that's currently in the middle of phase 1. Most of those that are in the clinical trials for HPV are using their solution that they derived called VIR 2218 that I previously mentioned. And then they're pairing it with other drugs to see how that is necessarily working. And so the HPV market for chronic hepatitis B is about 22.5 billion. And I only modeled them capturing about 1.2% of the market. And then I also included the fact that they were only, as a conservative estimate, netting about 60% of the sales from the partnerships. And that still increases the revenue by a few million every year after it would pass through the final stage.
You just went, all right.
Hi, Kendra, great job. Just going through your write-up. So you did a 5-year DCF, and then your third driver talks about the valuation could be upwards of $35 billion in the early 2030s. And then earlier, just guess the overall question is, if this were to get into the portfolio, how long of a hold would you picture it being?
Absolutely, that's a great question. So you're just asking, like, how long of play you believe that should be. Based on everything that I've read up on the company and the fact that many of their products are in the phase 2 pipeline, I would say at least until 2035 it would be great. Then you're really able to see how many of the products that are currently in the pipeline for phase 2 are able to come along. It seems like some of their more promising ones in the ideation aspect for solutions are still only in phase 1 or just past phase 1. So like their influenza treatment or their HIV treatment, which the Bill and Melinda Gates Foundation promised $40 million in grants to for research, but again, they're only in the first phases, so I don't want to include those and make it an extra long hold if the things don't play out. So, in my opinion, around like 2035.
We'll go online, then in room, then online. Online, Roman Man asks, notwithstanding COVID-19, do you have any sense how the spotlight on COVID may have expanded their total addressable market over the next 5 years? Can you provide, we'll start there. Can you provide any pipeline, any color on their pipeline? So we'll break it into pieces. Any idea how COVID has expanded the total addressable market of what they're addressing over the next 5 years? Is it expanding, contracting it, flatlining it? What are you thinking in that COVID drug?
Absolutely. So you're asking how I necessarily modeled that into the growth of the revenues based on what I believe is going to.
You can frame it the way you want. We'll left it hanging for you.
All right, sounds good. So from what I projected in my revenue growth, I projected that their doses for COVID solutions are going to grow by 15% this next coming year, and then start declining or decreasing based on news that perhaps COVID will speculatively either become less severe, so we'll stop needing as many treatments, or that cases will start dropping and we'll start having herd immunity. So I just wanted to be conservative, so I had a drop in 20%, and then in 2025 by 10%, and then flatlining.
And then the second question, which is, if you can address it briefly, is I know there's a lot of drugs in pipeline. In a very brief manner, not covering all, can you give us some color on what that pipeline looks like?
Is that just pertaining to the COVID solutions?
No, they have a whole bevy of drugs. So can you just give, do you have any idea roughly how many are stage 1, 2, 3, any range of years they're coming in? Just something very brief that answers Will's second question.
Yeah, absolutely. So in the stage 2 pipeline, it seems like there's about 8 solutions that are in stage 2, in the middle of that, or hearing solutions by, or the results by the second half of 2022. And there's about 2 solutions in the middle of phase 1.
All right. And then Ryan Hamilton, last question. Any comments on the potential for Eli Lilly to acquire the stock? Are you trying to pick this an acquisition? What's the chance of that?
Oh, as in, okay.
Yes, we're going to get bought out, right? Or not? What do you think?
As of right now, I understand that they have a partnership with Eli Lilly to partner their antiviral treatments. As of right now, it seems like they're only going to continue on with partnerships, with Eli Lilly rather than being bought out. There's been no speculative.
But of course, since they're a major player, they could take out my company, and that's even another reason to buy a stock. Got it. All right.
Yes.
Here's the process we follow now. The 5 students will come up and just briefly talk to us about what they will propose to sell out of the portfolio in order to replace those with the stocks presented today. All right, we'll do this again next week. 5 stocks. Have a good weekend. Everyone take care.
Absolutely. There's only one answer to that question. Hell yes. That was the last one.
I was so I feel like my question was like worded so bad that you probably had trouble understanding.